All right, so if you've seen some of my videos before, you'll know that bonds aren't something I usually talk about. Until now, the ones that have good interest rates, well, they're usually junk bonds, bonds that are risky and have a high possibility of default. But the good ones, like the savings bonds that are backed by the US government, well, those usually come with interest rates so low that it's not really even worth looking at. I mean, until recently, the 10-year Treasury was yielding just over 1.5%, and today it's at 3%, better, but still, 3% isn't going to get you very far, especially with inflation over 8%. So, what do you do if you have a little extra cash to spare? Well, you could buy stocks, but stocks have been having one of the roughest times in history this year. Or you could look at Series I savings bonds. Right now, they're offering a compelling reason to buy, a 9.6% interest rate, and I think it's worth having a look at. Series I bonds, or known in the industry as I bonds, are backed by the US government, and they're designed to offer protection against inflation. And unlike other bonds that can potentially lose value, others issued by the US Treasury, like, well, Treasury bills, I bonds don't. It's like having your cake and eating it too. And more on that in a little bit. All right, before I talk about I bonds, let's figure out what a bond actually is. A bond is a type of investment that can be used to provide stability and security for one's finances. When a company or the government wants to borrow money, they issue bonds. And you, as the bondholder, are loaning them that money. In return, the borrower agrees to pay you back the amount of the loan plus interest. Now, there's many types of bonds available, and each has its own unique benefits and risks. When you buy a bond, you're essentially lending money to the bond issuer. In return, the issuer agrees to pay you interest on your investment and repay the principal amount of your investment when the bond matures. And I bonds are special because they offer a unique blend of security and earnings. I bonds are offered by the US Treasury through treasurydirect.gov in any denomination over $25. So if you want to buy $25 or $30 or whatever, you can do that. You can also buy a paper version using your tax return in denominations of $50, $100, $200, $500, and $1,000. Regardless, they're sold at face value. For example, a $100 I bond costs $100. When it comes to I bonds, there are two interest rate components. The fixed rate, which does not fluctuate with changes in inflation or interest rates, it's fixed. And the variable rate, and that one changes every 6 months. And if you add up the fixed rate with the variable rate, you get what's known as the composite rate. And that's the total amount of interest you get annually. The Treasury sets the variable rate every 6 months, on the first business day of May and on the first business day of November, based on changes in the non-seasonally adjusted consumer price index for all urban consumers. It's known as the CPI-U for all items, including food and energy. However, the change is applied to your bond every 6 months from when you bought it or the bond's issue date. Now, the current fixed rate on I bonds, if you bought one today at the time of this recording, is 0%. However, the variable rate is a mouth-watering 9.6%. Now, it's not going to be 9.6% forever. But if you believe that inflation is going to be around for a while, this could be an interesting bond for you to check out. I bonds also provide certain tax breaks, making them a more attractive option than other investments. For example, I bonds are exempt from municipal and state taxes. Also, the interest can be used for higher education, making it tax-free. Now, that said, if you're subject to federal tax, you can defer the tax until you sell the bond. And if you're good at tax planning, you'd sell the bond in a year when you have a low income. That way, you'll pay a lower amount on the interest, because your marginal rate will be lower. When it comes to buying bonds in general, the main risk revolves around redemption. Think about this. Suppose you need your money before maturity. Maybe you want to buy a home or pay for a wedding. Well, with other bonds, you probably won't get the face value of the bond, but rather you're going to get whatever the bond is trading at the time you want to sell it. It could be more than face value and it could be less. You see, most bonds trade opposite to the direction of interest rates. So if you bought a bond today and interest rate goes up, well then the bond value decreases. And of course, if interest rates go down, then your bond value increases. So you'd have to wait to maturity if you wanted to get your entire face value back. But with I bonds, your redemption value is always the face value of the bond. In other words, if you bought $100 in I bonds, well, you can sell it back to the Treasury at any time after a year for its face value, or $100. The only thing to note is that if you sell your bond between year 1 and year 5, you're going to forfeit the last 3 months of interest. So if you think you're going to need the money within the next 5 years, it might be worth looking at a shorter term investment like Treasury bills if you want that same security. Another thing to look at is what inflation will look like in the future. Remember, today's I bonds have a fixed interest rate of just 0%. So when inflation levels off or comes down, so will the variable rate. That said, you can always sell your bonds in year 1 to 5. You'll only give up 3 months of interest. And if you've owned the bonds for more than 5 years, well, you can sell them back to the Treasury with no penalty. To be eligible to buy I bonds, you must be one of 3 things: a United States citizen, no matter where you live, a United States resident, or a civilian employee of the United States, again, no matter where you live. If you want to purchase I bonds, you can do so online through treasurydirect.gov or in paper form using your federal income tax refund. The minimum purchase amount electronically is $25, and the maximum amount of I bonds that someone can purchase is $10,000 per calendar year in electronic format. And in paper format, investors can use their tax refund to purchase up to $5,000 a year. I bonds are denominated in US funds, and that means you cannot buy them in any other currency. So what does this all mean? If you're looking for a safe investment that offers some nice tax breaks, Series I savings bonds might be right for you. Just remember though, if you're going to need the money sometime in the next 5 years, there could be better options out there. Also, keep an eye on inflation. When it starts to level off or come down, so will the variable rate on your I bonds. And at that point, you can look to sell them and then move your money to some more interesting investments. Have you bought any I bonds? Let me know in the comments below. Let me know why. I love reading and responding. In the meantime, if you haven't already, go ahead and hit that subscribe button so that I will see you in the next video. Bye.